Okay, let's start with a crazy question. Can you magically turn a 10 crore loss into a 40 crore profit with just a couple of accounting tweaks? I mean, it sounds impossible, right? But this is exactly the kind of problem that can show up in your exams. Imagine this. A company's board is panicking over a huge deficit, but with a few clever adjustments, suddenly they're reporting a massive profit. Is that even allowed? Let's figure out how to tackle a situation like this. So, this scenario isn't just made up, it's actually based on a classic exam problem featuring a company called Jagannath Limited. They promised their stakeholders a 40-core surplus, but ended up with a 10-core deficit. The board then swooped in and made two adjustments to fix the numbers. Now, your job as a future chartered accountant is to figure out if what they did was legitimate, and more importantly, how you'd structure your answer to get full marks.
To crack this case, we need to think like financial detectives. And our main tool? That's going to be Accounting Standard 1, which is all about the disclosure of accounting policies. Here's our game plan. First, we'll nail down the fundamental ground rules of accounting. Then, we'll look at the principles you use to choose your accounting methods. And finally, we'll circle back and use all this knowledge to solve the Jagannath case, so you're ready for any AS1 question that comes your way.
All right, before we dive into the nitty-gritty of policies, we have to talk about the three fundamental accounting assumptions. Think of these as the unspoken rules of the game. They're so basic and so important that everyone just assumes you're following them unless you specifically say you're not.
Here are the big three. First up, going concern. This is super simple. We just assume the business isn't about to go bust, right? It's going to keep operating for the foreseeable future. Second, we have consistency. This one's all about not changing the goalposts. If you use one method this year, you stick with it next year for the same kind of transactions. It's all about making things comparable. And third, accrual. Now this one is huge. It means we record transactions when they happen, not when the cash actually moves. This gives us the real picture of a company's performance.
Now, here's a critical point, and honestly, a major trap that ICI loves to set. If you're following these three assumptions, you don't have to say a word in your financial statements. Silence is golden. It means you're complying. But the second you break one of these rules, let's say the business is not a going concern anymore, you have to shout it from the rooftops. You must disclose that fact. This is a favorite spot where students lose marks, so pay close attention.
Okay, so you might be thinking, if everyone's playing by these same three rules, why do company accounts sometimes look so different? Well, the answer is in the accounting policies. This is where management gets to make some choices. And to make sure those choices are good ones, we have a set of guiding principles. This is our detective's toolkit.
So what exactly is an accounting policy? Well, it's a two-part thing. First, you have the principle, like how are we going to value our inventory? And second, you have the methods you use to apply it, like are we using FIFO or weighted average? Both are totally fine, but the one you choose has a direct impact on your profit and your balance sheet. That choice is your accounting policy.
So, how do we pick a policy? The first big principle is prudence, which you probably also know as conservatism. The mantra is super simple. Don't count your profits until they're in the bank, but definitely account for every possible loss you can think of. The whole point is to make sure your assets and profits are never overstated. The classic example? Valuing your inventory at its cost or its net realizable value, whichever one is lower. That's prudence in action.
Next up is substance over form. This one basically says we're accountants, not just paper pushers. We care about the economic reality of what happened, not just what the legal contract says. If a company structures a deal to look like a lease, but in reality it's a sale, well, we account for it as a sale. We look at the substance, not just the legal form.
And the third principle is materiality. Here's the simple way to think about it. If knowing about this one item could change an investor's decision, then it's material. And it's not just about big numbers. A tiny fraud of, say, 5,000 rupees is highly material. Why? Because it tells you there's a serious problem with the company's internal controls. It's all about the influence of the information.
Okay, exam tip time. While materiality sounds like it's all about judgment, the Companies Act actually gives us some hard numbers you absolutely have to know. These rules tell you exactly when an income or expense item is big enough that it needs to be disclosed separately. Okay, get your pens out. Here's the number you need to burn into your brain. You have to separately disclose any item of income or expenditure that is more than 1% of your revenue from operations or 1 lakh rupees, whichever is higher. Seriously, memorize this. It's a direct, practical rule you can easily be tested on. Right, so we've picked our policies using prudence, substance, and materiality. We're all set, but what happens when we want to change one? Remember that consistency assumption we talked about? It says we shouldn't really be changing things, but sometimes you have to. So let's look at the rules for that.
You can't just change a policy on a whim to make your profits look good. Nope. There are only 3 legit reasons you can do it. 1. The law changes and you have no choice. 2. A new accounting standard comes out that requires it. Or 3, and this is the one that requires judgment. The change leads to a better or more appropriate presentation of your financial statements. You really have to justify this last one.
So, you've made a valid change. Now what? You have to disclose it, and here's a simple little decision tree for you. First, ask yourself, is the effect of this change material this year? If it is, move to step 2. Can we calculate the exact financial impact? If you can, great, you disclose that number. But what if you can't calculate it? You're not off the hook. You still have to disclose the fact that you made the change and just state that its effect isn't ascertainable.
And here is what a perfect, gold standard disclosure note looks like. It's not enough to just say, hey, we changed our inventory method. No way. You have to be specific. Look at this example. It clearly states the change was from FIFO to weighted average, and it quantifies the impact. It reduced current profit and value of inventory by $20,000. That is the level of detail you need for the exam.
Okay, team. Detective training is over. We know the assumptions, the principles for choosing policies, and the rules for changing them. It's time to go back to the beginning and solve those cases.
So, back to Jagannath Limited. Were they allowed to do what they did? Well, the policy changes themselves might be okay if they can justify that they result in a more appropriate presentation. But, and this is the big but, the most critical part of AS1 is all about transparency. They absolutely have to fully disclose the nature of both changes and their exact financial impact. No hiding the ball.
Let's actually look at the math and see how the magic trick worked. They started in a 10 crore hole. Then, boom, the inventory change added 20 crores to the profit. After that, the new provision for investments took away 10 crores. The net result? They're at 0 profit. This entire calculation has to be shown clearly in the notes to the accounts so everyone can see exactly how they got from a loss to break even.
All right, on to our second case, XYZ Company. They didn't provide for overdue interest on their loans. Instead, they just mentioned it in a note, calling it a claim not acknowledged as debt. Is this okay? Absolutely not. Their treatment is just plain wrong.
Here's the breakdown. The company tried to hide behind a legal argument, but AS1 forces us to look at the financial reality. And the reality is, this is a massive violation of 2 of our core principles. It smashes the accrual assumption because that interest expense has been incurred, whether they like it or not. And it completely ignores prudence because they failed to provide for a liability they know exists. A provision is required, period.
Okay, we've gone through all the theory, we've applied it to a couple of cases. To make sure this all sticks, let's finish up with a quick-fire revision round. Just a couple of typical exam questions to lock it all in.
First up, which of these is not a major consideration when you're selecting accounting policies? Your options are A, prudence, B, comparability, C, materiality, or D, substance over form. Think about it for a second. The correct answer is B, comparability. Why? Because prudence, materiality, and substance over form are the principles you use to choose a policy. Comparability isn't a selection criteria, it's the result you get from applying your policies consistently.
And for our final brain teaser, this one is a classic ICI curveball, so listen close. A company changes an accounting policy. This year, it has literally 0 impact on the numbers, but they know it's going to have a massive impact in later years. What do? The answer, and this is where marks are won or lost, is that you must disclose the fact of the change in the current period, even with no financial impact yet. AS1 is clear. If a change is reasonably expected to have a material effect later, you have to disclose the change now. And knowing that little detail, well, that's what makes all the difference in your exam.